Welcome to Today Dollar Talks, where we break down the global forces shaping money, markets, and your financial future. I'm your host, James Carter, and today we're exploring one of the most fascinating rivalries in modern economics, the US dollar versus the euro. Why does this relationship matter? Because when these two currencies move, the entire world feels it. From the price of your morning coffee to the return on your investments, their dance affects everyone. To help us unpack this, I'm joined by Dr. Elena Morales, economist and professor of international finance. Elena, welcome.
Thanks, James. It's great to be here, and I love that you called it a dance. That's really what it is, a delicate rhythm of power, trust, and global confidence.
Exactly. Let's start right there. For those who may not follow currency markets closely, how would you describe the dollar-euro relationship?
Well, imagine two giants sharing the same stage. The dollar represents stability. It's the century-old oak tree deeply rooted in the world's financial system. The euro, on the other hand, is a young but ambitious forest, planted just 25 years ago as a symbol of European unity. Since its birth in 1999, the euro has challenged the dollar's dominance. Their relationship isn't just about exchange rates, it's a reflection of political will, economic confidence, and how people around the world perceive safety in times of uncertainty.
I love that imagery, the oak and the forest. Let's go back to the beginning. How did this all start?
The story begins on January 1, 1999, when the euro was officially launched. At first, optimism was high. 1 euro traded for about $1.17. But within a year, doubt set in. Investors questioned whether a currency without a single country behind it could survive. By 2000, it fell to 0.82, its historical low.
Meanwhile, the dollar was in its golden era. The US tech boom was roaring, Wall Street was thriving, and the euro still felt experimental. But that changed after the dot-com crash and the 9/11 attacks. Global investors sought stability, and Europe offered attractive interest rates and fiscal discipline. By 2008, the euro reached an all-time high of $1.60.
So in less than a decade, it went from skepticism to strength.
Exactly. For a moment, many believed we were entering a multipolar world, that the euro could rival the dollar as a global reserve currency. Then came the 2010s, and things got turbulent again.
Yes, the European debt crisis hit hard. Countries like Greece, Spain, and Italy struggled with massive debt and austerity. Investors worried that the eurozone itself might fracture. The euro lost value, falling to around $1.05 at points. That's when Mario Draghi, then president of the European Central Bank, delivered his famous line, "We will do whatever it takes to preserve the euro." Those words, backed by large-scale bond buying, restored confidence, but they also showed how dependent the euro was on political unity among very different nations.
Meanwhile, the US recovered faster from the 2008 financial crisis, right?
Correct. The Federal Reserve raised interest rates sooner than the ECB. Higher U.S. rates attracted capital, strengthening the dollar. It was a classic example of how monetary policy drives currency flows.
Let's pause on that. For listeners who may not know the mechanics, when a central bank raises interest rates, what happens to its currency?
Great question. When a country raises interest rates, investors earn higher returns on assets denominated in that currency. So money flows in and demand for that currency increases. That's why watching central bank decisions, the Fed in Washington and the ECB in Frankfurt, can tell you a lot about where exchange rates might head next.
Then we get to 2020, the pandemic, a truly global shock.
Yes, COVID-19 turned the world upside down. Both the Fed and the ECB unleashed record-breaking stimulus programs to prevent collapse. Initially, the euro gained ground, reaching about 1.23 in 2021. But as inflation surged, the story flipped. The US moved fast, hiking rates aggressively. Europe, however, faced a double crisis: rising prices and energy dependency after Russia invaded Ukraine. In 2022, for the first time in 20 years, the euro fell to parity with the dollar, 1-to-1.
I remember that headline. The euro hits parity. It felt symbolic.
It was. It marked a new balance, showing that neither currency is invincible. By 2025, the exchange rate stabilized around 1.15, but the message was clear. Global confidence can shift overnight.
Let's bring this closer to home. How do these swings affect everyday people?
The impact is huge, though often invisible. For example, when the euro strengthens, an American tourist in Paris might find that same €70 meal costs $80 instead of 70. For European importers, a strong dollar means paying more for oil or technology. Even your investment returns are affected. If you hold a European stock fund and the euro weakens, your dollar-denominated value drops, even if the stocks perform well locally.
So currency fluctuations seep into everything from travel to retirement savings.
Exactly. That's why it's important to monitor trends. Use reliable sources, the ECB, the Fed, Bloomberg, and when possible, diversify your assets across currencies. Don't keep all your eggs, or in this case, one currency.
Let's unpack what actually drives these shifts. Beyond interest rates, what are the main factors?
I'd group them into 5: monetary policy, inflation, capital flows, institutional confidence, and trade balance. When inflation rises faster in Europe than in the US, the euro's purchasing power erodes. When investors fear political instability, say a contentious election, they rush toward the dollar for safety. And when Europe exports more than it imports, demand for euros goes up. Think of the exchange rate like a seesaw. Any change in these factors can tilt it instantly.
That's a perfect image, and it leads us to the emotional side of money.
Yes, confidence is everything in currency markets. It's intangible but powerful. When citizens trust their institutions, the currency holds steady. When they lose faith, even the strongest economy can stumble.
That's why I always tell my students, currencies are mirrors, reflecting how the world feels about a nation's future.
That's profound. So, in a sense, the dollar and the euro are emotional barometers for global trust.
Exactly. And that trust can shift quickly. The euro's early fall wasn't about weak economics, it was about skepticism. The dollar's struggles during the 2008 crisis weren't due to lack of size, but loss of confidence. Let's pivot to lessons we can take away, especially for investors and professionals listening.
Lesson 1 is no currency is invincible. The euro's fall after 1999 and the dollar's weakness post-2008 prove that cycles happen. Lesson 2, policy matters. Central banks shape reality more than market rumors. Lesson 3, diversify. Holding assets in different currencies cushions you from volatility. And finally, remember that understanding history helps you anticipate the future. Every major shift we've seen, from parity to peaks, echoes past cycles of confidence and correction.
I love that. And it's empowering, too. Instead of fearing volatility, we can prepare for it.
Precisely. If you view currency movements as waves rather than earthquakes, you can ride them instead of being knocked down.
That's such a great metaphor. Let's end with a broader reflection. What does this rivalry, the dollar and the euro, tell us about the world today?
It tells us that financial power is no longer concentrated in one place. We now live in an interconnected system where decisions in Washington and Frankfurt ripple across continents. It also shows that cooperation matters. The euro was born from a vision of unity, and the dollar maintained strength through global trust. Both remind us that money isn't just economics, it's a social contract built on belief.
Beautifully said. Before we wrap up, give our listeners one actionable takeaway.
Sure. Whether you're a traveler, investor, or business owner, pay attention to signals, interest rates, inflation data, political stability, then plan accordingly. Diversify your portfolio, set alerts for exchange rates, and think globally about your money. Because in a world where currencies compete, awareness is your best defense.
That's excellent advice. Dr. Elena Morales, thank you so much for joining us.
My pleasure, James. Always a joy to talk about how the numbers on a screen reflect the deeper story of trust and resilience.
And to our listeners, remember, the story of the dollar and the euro isn't just about economics. It's about how confidence shapes our world. Thanks for tuning in to Today Dollar Talks. If you enjoyed this episode, subscribe, share it with a friend, and check out more insights at todaydollar.com. Until next time, stay curious and stay informed.